Welcome to this episode of the Legal Paige podcast. Today's episode is all about gifting as a business owner and whether that gift that you give your clients or your workers on your team is tax deductible or not. I am so excited to have CPA Amy Northard here to join us and dive into this subject more and help you guys get your ducks in a row when it comes to taxes by the end of the year. Now, let me tell you a little bit about Amy. Amy is the accountant for creatives. She's a certified public accountant, or CPA, who specializes in working with creative small business owners to make taxes and bookkeeping less stressful. She has a passion for helping small business owners wade through all those financial things that it takes to start and operate a business so that they can get back to focusing on their craft. In addition to preparing tax returns and bookkeeping for clients all over the United States, Amy enjoys teaching small businesses financial basics through her online course, Be Your Own CFO. Without further ado, I think it's best to just talk all things gifting during the holiday gifting season with my friend Amy Northard. Let's get into this episode, Legal Pagers. You're listening to the Legal Paige podcast, where we chat about life and business with a legal twist. I'm Paige, attorney and photographer helping online businesses and creatives tackle their business dreams without breaking out in hives. No more legal mumbo jumbo. This podcast features simple, bite-sized advice that'll have you legally legit in no time. Are you ready? Let's get started. Hey everyone, thanks so much for tuning in today. I am really excited to have my friend Amy here to talk about gift giving as a business owner and what you truly can use as a tax deductible expense. So it's that time of year again where we are approaching not only the end of the year, but a time when we're really trying to maximize the most of our deductibles in our business. It's also the holiday season. I think we all get a little swept away with giving lots of gifts to our clients and people who work on our team. And last year, I kind of noticed that a lot of people weren't doing this the right way, and they had lots of questions popping up for me in my DMs and in my Facebook group. So I have Amy here to talk to all of you about that. Amy, thanks so much for joining us on the podcast.
Thanks for having me.
Amy, I know you pretty well, and I gave a little intro to everyone at the beginning of this episode, but I would love you to kind of just explain your journey and how you got to doing what you do right now as a CPA.
Sure. So I did the typical thing, went to college, got my CPA license, was working at a accounting firm, and long story short, I just couldn't envision myself doing that for the rest of my life, working there. So I had to figure out a way to adapt, all of the knowledge, all the time spent in getting that license to something that I would enjoy every day. So here we are. I love working with creatives. They're so inspiring to follow and watch their journey, watch their businesses grow. And it's just really rewarding to be a part of that, as I'm sure you are familiar with.
Yeah, I am like lawyering for creatives and small business owners, and you are accounting for them. How did you particularly get into the creative space? Like, how did you go from the traditional kind of accounting lifestyle to solely working for creatives? Did you have a background in it at all?
I would say I've always been a little bit more creative myself. I needed a creative outlet when I was working in that firm. So I started a blog with aspirational goals of being a food blogger that never panned out. So
I love it.
Just, it's always been, I've always had that interest myself. So it's just fun to work with people with a similar interest.
Gotcha. And so I know you have lots of good resources on your website, but you primarily do bookkeeping and CPA work for small business owners. Is that correct? How can people kind of work with you before we just jump into gifting as a business owner here?
Yeah. We do bookkeeping. We do tax preparation. We have also, over the past couple of years, kind of shifted into also providing virtual CFO services. So that's just kind of the next level of working with business owners on a way more frequent and close basis to see what's going on, consult on expansion and those kinds of things for business owners that are ready for that.
Perfect. And I can let you all know now, having someone like Amy on your team is priceless. It is so worthwhile. I wish I would have done it way sooner in my career. Coming from someone, I do have like an economics and I didn't like graduate with a major minor in accounting, but I took a lot of business and accounting classes. And then, obviously I specialize in the law. And I think I always thought I could do it myself. I'm sure that's what lots of small business owners say, where we're like, oh yeah, we can do budget spreadsheets and figure out our lives ourselves. But at the end of the day, that's the first thing you should outsource, I would say, after, bringing on kind of a VA and like helping with small day-to-day tasks. I think having someone do your bookkeeping for you and looking at P&L statements and, like you said, like adding in that CFO lifeline to your business where you can talk big picture with somebody that really understands numbers and projections and expenses for you. And like you said, expansion, when you start really starting to scale and grow your team, I think having that like CFO lifeline is amazing and is one of those essential outsourcing things that business owners need to do. So I love the service you provide. And you guys, Amy is one of our referred CFOs and CPAs through the legal page. So we are constantly sending people Amy's way. We have a list of good people that do bookkeeping and CPA tasks for small business owners. So Amy, yeah, thanks again for joining us here because I know you're a wealth of information on all things tax deductions. So as we kind of transition here into the big question of gift giving, I would kind of like to know from you, like what exactly, if someone's asking you just the basic question of, I'm a business owner and I want to gift my clients or I want to gift the people on my team. What is tax deductible? Like, what is the very first thing you would tell people?
I would say the most basic thing to understand is that you can gift $25, the value, $25 or less to your clients or your employees, and it doesn't need to be, they don't need to pay tax on it. That's kind of the limit. So if you are gifting to like a spouse couple, you could gift, the whole value of the gift could be $50 because you've got two people. And then you could do it again next year because it, turns over each year. And you can gift more than that per person, but from a deductible standpoint, up to that $25 per person can be shown on your tax return.
Okay, so as people are like starting to buy here in the holiday season, I think business owners oftentimes are thinking, oh, this is a quick way for me to kind of get a little bit more expensed by the end of the year. And essentially what you're saying is there is actually a limit that's pretty small in my opinion. I'm just going to like put it out there. And I think this is why it's such a confusing thing for people is $25 really isn't a lot. So you're saying, you can do more than that, but and especially if it's per person, how does that work with like teams? Like, is there a way to be like to Paige Marie Photography and her team? Is that a way to get around it and like expense a little bit more? I'm just thinking, lots of people like to spend anywhere from $50 to $100 for like larger kind of Christmas gifting purposes. How do they make that a little bit more expendable as a business expense?
I would say if it's something that can be reasonably shared among the team, then that would make sense. But if it's something that like doesn't make sense to share, and I can't think of anything good off the top of my head, but like maybe, I don't know. I can't think of a good example there, but if it's not something easily shared amongst the team or your team is spread apart and it gets sent to like you and you can't easily send off, their portion, you'd be still limited to the $25 per person.
Gotcha. How does shipping costs factor into that? Is it just the total of like the value inside the box and shipping can be separate?
Yes. So shipping does not count towards that $25 limit. And also like the wrapping that you do, tape, extra paper, packaging, that kind of thing, those don't go towards that $25 limit. And that can add up, especially when you're looking at just $25.
Yeah, exactly. Okay, so just the value of like the actual items in the gift. So any of the crinkle cut paper, anything along like cards, like happy holiday cards and things like that. Those are incidental costs is what you're saying.
Right. Exactly.
Gotcha. Okay, so the IRS kind of uses the example of gift wrap being considered incidental, but the pretty basket of like a fruit package might not be incidental when compared to the value of the fruit. Like there isn't really an example for shipping in terms of when it's no longer incidental. So I would say that since shipping doesn't really add value to the gift itself, it could be excluded. Is that correct?
That's correct. Yeah.
Okay. So kind of going back to the $25 per person limit, let's say gifts costing $4 or less that have your business name like permanently engraved on them. This is something, honestly, that has popped up in my business. And I've been like working with our bookkeeper and CPA on they always say like put TLP on it or put our sub brand name on it, because then you won't necessarily be confined to the $25 per person limit. Can you explain that a little bit more?
Yeah, those items are more seen as like marketing items since they have your name on it. And especially if it's, around that $4 or under amount, it's probably not going to provide them a whole lot of value in their life. If you're giving them a notepad with a pen that has your name on it, it's cool and it'll be useful, but it's not providing them a ton of value. So it's more of just having your name on their desk, top of mind, more of a marketing type thing.
Right. What about, I think lots of small business owners would think like mugs, or I've seen t-shirts where there's like a sub-brand kind of phrase on the front, but still like your logo on the back. Would those are like obviously more than $4, probably wholesale, at least a little bit more.
Right.
Is there would those still somewhat count as a deductible expense?
Yeah, I would say that. I mean, as long as you're not like buying a super expensive sweatshirt and then like in the little tiny corner where no one can see it, have like TLP embroidered on it,
yeah.
You feel like you're trying to skirt the rules by adding a logo to it, probably are. But in most cases, you would rather have it be a marketing tool. And in that case, it makes sense to be a marketing expense. They don't really have a limit in terms of marketing expenses because, I mean, if you think to like booths at trade shows, those booths are marketing expenses. They're going to cost thousands of dollars. So they can't really limit you on how much you spend on marketing expenses. But when thinking about like gifting items, I think it's just kind of a general, like, this is a small value versus a larger value kind of concept.
Gotcha. So kind of maybe even, I tell this to small business owners too, like you would maybe suggest, if you want to bulk up your $25, limit there, you could put in a little bit more swag type items where it's more just like keeping the front of the mind of whomever your client is, or, them using the mug or them using like a sticker on the back of their laptop, things like that, that kind of will add to the overall, I would say like items in your box that you're gifting them during the holiday season. Right. And it would kind of be above and beyond that $25.
Yeah, exactly. Yeah, I think that's a great idea.
Okay, perfect. I guess the last question that I have here surrounding kind of $25 that's more like along client status. So we're sending like our clients like lots of gifts or thank you things. Lots of business owners, I would say by like December 15th go, oh crap, I forgot to send something and now there's no way in God's green earth that I could get this shipped to them by Christmas. And then they start thinking of digital things they could send their clients as still kind of a way to get in a little bit more deductions by the end of the year, but also like show them some holiday cheer. What is, the tax law surrounding gift certificates and digital products and links that you would be able to send them?
I would say, the same thing would apply. So if you send someone $100 Amazon gift card, the first $25 of that would be deductible. You would still expense the full $100. It can still show up on your P&L, but you want to track who you're sending gifts to so that when you go to do your tax return, if you're doing it or your CPA is doing your return, they can basically count up how many people you gifted to and use the correct amount.
Okay, this is perfect. And I think people need a little bit more information because you and I totally understand what you just said. So $100 is like what you send someone in an Amazon gift card. You're saying you can still put that as an expense, but you have to track that it's a gift. And then only $25 would be used towards what when you're filing your 2021 taxes? Like what happens to the other $75? If you can put that in layperson terms for people, I think that would be really helpful.
Yeah. So the $25 will be an expense that will reduce your taxable income. The rest of it just doesn't show up on there to help you out tax-wise. So it will just show up on your profit and loss, that summary, and not help you out in terms of lowering your taxable income.
Gotcha. Yeah. So I always tell people too, that $25 is really important to remember that limit, because essentially we all want to do good and share, kind things with our clients and people on our team. But at the end of the day, if it's a gift, what are we trying to do with that extra $75? If it's not really helping our bottom line, then $25 is just fine. Will suffice plenty for gifting purposes.
Right. Yeah. Don't just gift to reduce your taxable income. And on a broader picture, don't just spend money to reduce your taxable income. Make sure that it's going to have a benefit for you.
Absolutely. Yeah. Because then essentially you're just giving money away, the extra $75. I always tell people, I don't know what percentage you use, Amy, but I use just 30%, 70%, because I think it's just easy for people to understand.
Mm-hmm.
Say, okay, $75 is hard because I can't do math right now. But say we're doing $100 and you did a $125 gift card and $25, it was an actual gift for Christmas purposes. So Amy's saying, okay, limit 25. So we've got an extra $100 there. That's really just a loss to you, essentially. It's an expense, but it's not going to lower your taxable income at the end of the day.
Right.
So I always tell people the 70-30 rule, if you had that $100 as profit for your business and you didn't actually just take that as a loss or increase the value of your gift by that much, you would still be taxed on 30% of that $100 of profit coming in, but you get to keep 70%. And so I think that's really valuable to people as they start thinking, oh, I just need to deduct and expend as much as possible. Something that and I have a CPA, you guys, in town. I have bookkeepers and online CFOs and people like that, but I also have just my hometown CPAs that are in Montana that help me with all of our businesses because we have, multiple diversifications of income coming in. And he always told me, you get to keep he says 65%. And so he's you could just keep 65% of that instead of spending it.
Mm-hmm.
And Amy said here, I think there's this weird mindset for small business owners that you should just be spending a bunch of money to reduce your taxable income. And that's not usually how it goes. Why not just get taxed on 30% of it, but you get to keep 70% of it instead of all of it being gone, the whole $100 being gone. I don't know if you have anything to add there, or if you tell your clients anything, a little trick or mindset psychology tip for them on the difference between spending and actually bringing in at least a percentage of that amount as profit.
I mean, I don't know that I have like a great, like little, nice, neat tip for everyone, but it's just important, especially as you're getting started. I mean, investing is important. Invest in the things you need, but don't keep investing just to use up your profit, because at the end of the year, if you have worked your butt off all year and you have no profit to show, you worked for free all year, and that sucks. So,
Yeah.
Having that, I mean, profit first is a big thing, but having at least a certain percentage, it can grow as you grow your business if you want, but making sure you're keeping some part of the hard work that you have put in to receive dollars from clients and customers, I think is really important.
Yeah. And for everyone kind of like wrapping up finances here at the end of the year, remembering that like having a basis in your business is still really good. So that's like overall profit that's just staying in your business. Like, what is your business actually worth? Beyond what you just pay yourself, right?
Mm-hmm.
Having that mentality as well, where I don't just have to be at like zeroed out at the end of every year where I'm just paying myself everything and then my business is back to zero by December 31st. Shifting that and realizing like your business is there, hopefully, unless you're a nonprofit, your business should be there to make profit. You should be making income as the owner, or, if you're an S Corp is the only one on payroll, so on and so forth. But your business should also be making money too. Do you agree with that, Amy?
Oh, yeah, 100%. Yep.
Yeah, I think people kind of forget that. They're like, as long as I'm making money and giving myself some type of income, then we're good. But what about your business? Like, I like to treat my business as kind of like a person too. Like, it should be making lots of money as well. And then it can have lots of savings accounts and it can be investing, and all of those things come with Amy talking to you in CFO world.
Yes.
All right. So that's for clients, $25. How does this work for like employees, team members? Are there different rules? Is there anything that could change in terms of, the small business owners that we work with? Some people have employees, but lots of people have contractors too. And they're just trying to like be super kind and like obviously tell them how happy they were with their services this year. Can you give us a little bit of insight into gifting those type of people?
Yeah. So I see a lot of people trying to get around the taxability of like bonuses by giving gift cards or other, more hefty gifts around the end of the year. And the thing to remember is that, those gifts over $25 will need to technically be reported as taxable income to them. So employees, it would show up on their W-2. Subcontractors, it would show up on a 1099 if the value of the gift plus anything you've paid them via cash, check, or bank transfer totals $600 or more.
Gotcha. Okay. So if you're giving like big gift cards or bonuses, you might as well just expect it to be either on their W-2 or on their 1099 at the end of the year.
Mm-hmm.
And so essentially what you're saying is just give them a bonus because it's just cleaner. I would say as a lawyer, like that's just cleaner looking, honestly. It doesn't make it look like you're getting around something.
Either way, like they know about loopholes, and that's why they have people add the non-cash gifts to W-2s, because they want their money any way they can get it.
Oh, don't they? Yeah, we love the IRS. Everyone's just kind of shaking their head and grudgingly shrugging their shoulders. Our state departments and the IRS loves taxing us. So that's just kind of the beauty of living in this country. I mean, it is there for a reason.
Right.
It is what we all have to do. But at the end of the day, I do usually just give bonuses, honestly, just cash bonuses, because I always feel like then it's cleaner for me. Like for my employees, it goes on their W-2 for 1099 purposes, because we have quite a few contractors that work for our team as well, because they run their own businesses and like work for other clients too. They just prefer the cash. Like they know that they're going to get taxed on it, but at the end of the day, then they can choose like what to use that money towards.
Right. Exactly.
So yeah, I always tell people like bonuses are really, they're still amazing. And so don't try to just like gift a bunch of things to get around it, essentially.
Mm-hmm.
Okay, so what happens if you're on the receiving end of those gifts as like a client? So obviously like a 1099 or a W-2, like an employer, a subcontractor they don't really have any way of changing that number. It's either it's going to be on your pay stub or it's going to be on your 1099 at the end of the year. You can't really fudge that number. But for clients in particular, like what are they supposed to do if it's over $25? Do they really need to do anything, or is it more just on your business?
Yeah, they don't really need to do anything. I mean, if you're on the receiving end of a gift under $25, there's nothing you need to do. If you receive a gift and you are providing services to them, make sure I have that on the right way here. So like if you are a wedding photographer and your client gave you a gift, then it could, if it's like cash, it could be considered a tip, and you would definitely need to be reporting that.
Gotcha. Okay, good to know. Does it change if you're like an employer subcontractor receiving those types of gifts? Obviously, I think what you're going to say is yes, it's taxable income here.
Right. Yeah. And it'd be taxable at the market value. So basically, if it's not a gift card or cash, it would be whatever they could go buy it for in the marketplace.
Okay. Gotcha. So like if it was some big item and then you were returning it to, I'm thinking like an adventure photographer or something here. Like someone gets them a really cool piece of gear that they could use with hiking and maybe it's $100 value, then you're saying like whatever the market value of that like actual tangible gift would be.
Exactly. Yep.
Okay, cool. Basically treat it like a tip.
Yep.
Let's dive into record keeping here as a business owner. So what sorts of records do you recommend people keep and how? So like they're making sure that if they do get audited, they're complying with tax regulations to the best of their abilities.
I think the easiest way is probably just to keep a spreadsheet of all of the names of people that you've sent, and then you can put the total value of the gift given. This way at tax time, you can just give that list to your accountant, or if you're doing your own taxes, you can pull it up and just say, okay, if I gave this person a $30 gift, they get $25 towards this deduction, and just do that for the total amount of people. Just keep in mind, like spouses count towards this. So if it's, if you shot a wedding for a couple, the amount that you could deduct for that couple would be $50.
Okay, cool. Good to know. So like, obviously you're probably, you're wanting all these cha-ching moments to come in and out of your business bank account, right?
Exactly. Yeah.
And then you're creating a separate spreadsheet that's like, here are all of the different gifts that I've been giving throughout the holiday season. Here's how many people that this like box is going to, and here's the overall value of the contents inside. Then your CPA would probably look at the line items of all of those gifts and obviously your bank statements and kind of line those up for you.
Yeah, exactly.
Okay, cool. What other sort of tax tips do you have for our listeners? Anything else surrounding gift giving before you touch on probably just like a couple little nuggets for people at the end of the year? Anything else gift giving wise that you've seen entrepreneurs make, like mistakes that they've made or things that they like forget about kind of in December of every year?
Around gift giving, the biggest thing I would say is make sure that the expense comes out of your bank account this year if you want to be deducting it this year. So if you put an order in and maybe you don't pay for it right away, you pay for it once it's complete and it gets sent out in early January, just remember that the timing of when it comes out of your business is going to be important. But other than that, I think just tracking is the biggest missing piece that I see when we're doing taxes. And then if we see a lot of gifting going on, then we need the client to go back and try to remember and recreate the list. And that is a huge pain. So if you can do it on the front end and just keep up with it as you go, that's really helpful for tax preparation and just so that you don't have to waste time trying to go back and recreate your records.
Gotcha. That's really helpful, seriously, because I do think people just get into the mode of like purchase, and like expend, and they're buying new gear, and they're like doing all these things. They're hiring lawyers and accountants. I don't know if that happens to you, but that always happens to us during the holiday season is like people are trying to get those professional expenses, and they're trying to do that cha-ching moment by the end of the year so that it is charged accordingly for like 2021 tax purposes. But keeping a list and a record of all of that will help your CPA out, and it will help you guys out because then you don't have to backtrack later on. What other little tips do you have for people in December? Is there anything that they should be looking at expense-wise, or just thinking, oh, I could get a little bit more here and a little bit more there if you're trying to reduce your tax liability by the end of the year? Because as you know, for lots of people, especially in the wedding industry, last year was really tough, but this year they're like making more money than they even know what to do with because they're so busy and they don't have time to spend it. And I can foresee that here in December, they're going to be like, oh gosh, there's so much income here. I always tell people like 70-30 rule, like you can still keep 70% of that if you don't deduct, like try to expense anything. Like that's still a lot of money. Yeah. So you're going to be fine if you take that all as profit. But is there anything that people could be like, okay, this might be a good time to think about expensing things since I've had such a good year, essentially because you've had to double or triple up on your clients coming in?
Yeah. So I would say there's a couple things. First, if there are things that you've been putting off, like gear upgrades or maintenance and that kind of thing, go ahead and get that in before the end of the year. Just remember, there's probably going to be a whole lot of other people trying to get that stuff done too. So do what you need to do. Spend the money you need to spend it on before the end of the year. If you can't think of anything, if you can't make a good case for something and you just want something because you want it, I would say hold off on that until you have funded your retirement account. It would be a great thing. It keeps money in your pocket, future pocket. It's there. It's not going to be spent on equipment that's going to need to be replaced and that kind of thing. It's not going to be spent on taxes, for that chunk of money. Most retirement accounts will reduce your taxable income. So I think that's a really good thing. And then also consider deductions that you have for things that you've already spent money on anyway. So a couple of those would be home office. You already paid for your house, whether you deduct it or not. Go through and be really meticulous in adding up your utilities, your rent if you're renting, your mortgage interest if you own, your housekeeper, any maintenance that you've done to the house. Those types of things, they take some time on your end, but you've already spent the money. So you're not having to spend more money to get the deduction. Same thing with mileage. That's another one that I see skipped more frequent than I like to see skipped because people just say, it's too much to deal with. I have too many things to track. I don't feel like dealing with it. And they skip it. And it could be thousands of dollars that you already spent money on gas for. It's not going to be an extra cost for you to get the deduction, just a little bit of time to either set up a good system, or if you don't have anything in place for this year and have to go back, get a spreadsheet, get Google Maps up, get your calendar up, and take some time to track that mileage.
Yeah, is for mileage, I know some people can kind of just take like a standard deduction, but you're saying there you could probably get more by actually tracking it. Am I following you?
Yeah, we don't really ever use for our clients like a standard deduction for mileage. We recommend that if they aren't tracking in real time, like through an app, like QuickBooks has an app and MileIQ is another one, you can pull up your destination from your home to the destination and then back to your home. you can add up that mileage on Google Maps. You don't have to track your odometer. As long as you have like your starting point, the destination, and why you went there. So it would just be like Joan's wedding.
Mm-hmm.
And then the total miles and the date. That's what you need to track for your mileage. And a lot of times that's going to be bigger than any standard number, as long as you're really meticulous about it.
Yeah, I've heard that before too, that it's honestly a lot bigger than standard deductions, so it's worth it to track. A couple follow-up questions on that. I know, obviously, we're talking about gift giving here primarily in this episode, but now I'm like, ooh, all these other deductions that people need to think about. Obviously, sometimes you can't go backwards, but moving forwards as we go into 2022, how does like gas work for that, or updates on your vehicle? If you're sharing it, it's like a personally owned vehicle, but you are using it for business purposes. I would say that's primarily what people do. And then for, I think some, like a photographer, for example, or a videographer, or even like a wedding planner is going to do what you say, like Joan's wedding. From like my house to the venue location and back is probably what they're going to track. What about like errands you're running in town and things along those lines? So first answer the errand question, like should people be tracking that kind of thing? It's if it's specific for your business purposes. And then maybe if you can attack kind of like what else you're supposed to run through your business bank account, car wise and gas wise.
Gotcha. So errands, yes. Anything like, even if you're going to the post office for the business to drop off something, anything that has a business purpose, you can deduct. I would say if you go to the grocery store and you happen to pick up some tape for your wedding kit or whatever, don't deduct that. You went to the grocery store to get groceries, probably for yourself and your family. That was the main purpose of the trip. You happen to get something for the business. But if you are running out of the house to do a site visit or something like that, those absolutely can be deducted. But that's another case where you need to be really good about tracking it all. And an app, which will start to track all of your trips automatically, like when you get over 5 miles an hour, that's going to be crucial in making sure that you are really good about tracking everything. And then the second part of that question, so in terms of what you can run through the business for auto expenses, I think accountants are going to probably have different preferences. For me, most of my clients end up getting a better deduction by just taking the mileage deduction. You get two options, mileage or the business use percentage of your auto expenses. So mileage, you just have to track one thing, your mileage. The other one, you have to track your mileage so that you can see how much you're using the vehicle for business purposes versus personal. And you have to track every single auto expense. So you have to track gas, tune-ups, oil changes, registration, all of that stuff. And since it's not 100% deductible, assuming you're using the car for personal stuff, if you ran all those expenses through your business, you would have to adjust those expenses. Your bookkeeper would have to do a journal entry every month to adjust it so that only the business percentage is being reflected as an expense. So it's a long answer.
No.
Kind of complicated, but I personally just prefer the mileage.
Yeah, I think other people do too. I think Amy's answer here, you guys, is like simplify, simplify, simplify. Mm-hmm. And the mileage is the way to go for many of us, especially people who are primarily using your vehicle for personal purposes. But you do want to get a little bit for tax purposes back from it. The last question I have for you is, as people are kind of rounding out the end of this year, receipts is often on their mind. Is it true that you don't have to have physical paper receipts for everything, and you can just use like the line items on your actual like bank account statement every month? Or how does that work? Like, what do you suggest people really do keep receipts for?
I think the threshold is like $75 for what the IRS wants to see receipts for, digital or paper. I mean, if you were to get a letter in the mail, like a paper audit from the IRS, they're going to ask for copies of your receipts. They're never going to ask for actual copies. So if you have digital copies, all you have to do is print them out. I would say don't spend more time on this than you need to, because the chance of you getting an audit is incredibly small.
Mm-hmm.
And if that happens, have your receipts in a way that if you needed to go back and send the IRS all of your advertising receipts, you could do that. But I wouldn't spend time having an advertising receipt folder and a meals folder. Just put them somewhere. You can pull them if you need them, maybe date them and have a folder for every year.
Gotcha. That's really helpful. Yeah, you guys, like on Gmail, I keep a folder of like miscellaneous expenses, and like as the digital receipts come in, I just file them in there. It's kind of like file it and forget it kind of thing, where if I had to pull it up, I could. And then I also, Amy, like really try to buy things on platforms where I can go back and track, whether that's PayPal or whether that's Amazon. Like there is a receipt involved somehow if I need to go backwards and search.
Yeah. And I mean, they say, the IRS says like, we can't rely on bank statements. So if you have one and that's like your last option for trying to prove an expense, it can't hurt to highlight it and submit that if you were to get a paper audit, but don't just rely on your statements.
Very helpful, I think, as people kind of round out this year. If there's anything receipt-wise that you guys are thinking about now as you're listening to this podcast episode and you're like, ooh, I think that was, a couple $100, cha-ching moment in and out of my bank account, I should probably just go find that receipt and make sure I have a digital copy of it. That's always a good thing to do by the end of the year. So you're not doing that prior to tax filing in March or April of 2022.
Yeah.
The last thing that you touched on retirement accounts. Just as people are thinking about all of these things in December, is there anything that they should talk to their CPA or bookkeeper about prior to year's end? Because I know there's some retirement accounts you can contribute up to the tax filing date. So if people missed a couple things, they could contribute at least somewhat in 2022 and count that towards 2021. Is there anything in particular, though, that like if they don't jump on it right now, they will miss out for 2021?
Yeah. So without getting too in depth in retirement accounts, simply like a SEP IRA, a traditional IRA, and a Roth IRA, you can contribute to after the year's over up until you file your return. But they have pretty narrow limits on what you can contribute and how much is going to be deductible. A solo 401k is an option for solo business owners who don't have employees or are a husband and wife or spouse and spouse couple running a business. And that needs to be set up before the end of the year and contributed to. Same thing with regular 401ks. If you have that, those can't be done after the fact. So, and the reason those are desirable potentially over a SEP IRA is they allow you to contribute at higher rates. So if you are really gung-ho on wanting to max out your retirement in any way possible, that's why people prefer the solo 401k over the SEP, is because it allows you to contribute a lot more.
Gotcha. And you guys, this was something that I had a mistake on. So that's why I asked Amy. I will never forget making this mistake in 2020 for filing my taxes. And there was like all these accounts we were supposed to put funds into, and we missed a couple by the end of the year. And my CPA was not happy with me. And so we were trying to like fund all these accounts after the fact. And we just like, you miss out on thousands of dollars essentially of good tax deductions that you can be taking. And remember, like Amy said in this episode, like that's still your money. You're just going to like use it later on. But it's a good way for tax liability purposes to reduce your taxable income right now. And so anyway, spreading out income and spreading out like when you're going to be taking funds, if you like Amy said, if you don't need it as an expense right now for like gear or equipment or anything like upgrading computers, like why not put that in some retirement accounts to use later on, and you still get the same benefit, but it's actual cash in your hand later down the road. So all good things to think about, Amy. Thank you so much for giving us all of your wealth of information on gift giving and deductions. I have a couple rapid fire questions here as we round out today's episode. Are you ready for them?
I am.
Okay. These are just fun questions that you guys, I like to ask guests because it gives everybody like human aspects to what we're talking about. The Legal Paige podcast is obviously legal related, and we obviously talk about taxes as well. So this is just a fun way to end. What is like your favorite munchie food?
So it used to be Flaming Hot Cheetos, but as a recent Crohn's diagnosis, I cannot eat spicy things anymore. So it would be Cheez-Its.
Ooh, well, that's a good change.
It is.
What have you been binging anything on Netflix or Hulu or Amazon Prime? Any like good shows you've been watching lately?
I usually find something to binge during tax season that can like play in the background, and Grey's Anatomy is always that. But if I want something to focus on, I like Outlander too.
Ooh, both great ones. Yeah. I am such a Grey's fan. I've watched all seasons way too many times. Mm-hmm. What's your like biggest pet peeve from anybody? Like if someone were to do this, it would just drive you up the wall.
Well, so I live in a house of boys. One is 4 and one is 34. And pee on the toilet seat is not fun.
Yeah, that's a good one. Lift it up, boys. Yep. Lift up that seat. What type of music do you like the most?
You can't go wrong with Taylor Swift. And then I also, like when I need to focus, I listen to acoustic rap on Spotify.
Oh, I love it. That's awesome. So last one is, what's your favorite bevy right now? Alcoholic or non-alcoholic?
I love any type of pumpkin beer. Coffee's a go-to, but pumpkin beer is my favorite.
Yeah, and it's good during the fall season. I hear you. All right, Amy, thank you so much for your time. Where can people find you? I know you have lots of good, valuable, like free resources out there that people could get started with, working with you on, or if they are like, oh my gosh, it's the end of the year, I might need to reach out to Amy and ask some questions. Where can they find you?
Yeah, you can find me on my website. We try to be really transparent with the pricing. So there's little calculators on there. The blog is great on there. Lots of free info. And then Instagram is kind of my creative outlet, someplace where I can post fun pictures of calculators and links to our blog posts when we come out with those.
Perfect. And you guys, I will make sure to link Amy up everywhere where we are putting all of the show notes for this episode and anything that we put out on social media as well. So you'll be able to easily find Amy. Thank you so much for joining us today. I know that was really helpful to all of our listeners.
Thanks for having me.
Thanks so much for listening to this episode of the Legal Paige podcast. See, I told you being legally legit isn't so scary. Be sure to visit thelegalpage.com for all show notes. And it would be super awesome if you could head over to iTunes and leave a review. Last but not least, don't forget to join my free Facebook group for unlimited legal and biz Q&A. Chat soon, Legal Pagers.